I mean, you've worked at the highest levels now in both academia and policy. How would you compare the two?
They're obviously very different. When you're working in policy, if you're in the right place at the right time, you can have an enormous amount of influence. You can do things that actually change people's lives and you can feel good about it. Academia, it's more you're trying to write for the people who might have the possibility of changing. But if you can reach the right person with your advice, then academia also has impact.
Well, good morning, Raghu. It's great to have you here at the University of Zurich. Welcome to Zurich. It's a great honor to have a conversation with you this morning. You're here for our UBS Center Forum, where we're going to discuss the question, global trade in crisis, what's next? And I would suggest we also discuss this question here a little bit this morning. But before we get there, I thought it would be great if we talk about your intellectual journey a little bit. We know you're a professor of finance at the University of Chicago, Booth School of Business. You were also the chief economist of the IMF. You were also the governor of the Reserve Bank of India and held many other esteemed positions in policy and academia. But maybe just to get us started, I'd be curious if you could tell us a little bit about, well, your life, your biography, but also specifically the move between academia and policy making and how this all came about.
Well, how many hours do you have? Well, first, thanks very much for having me here this morning. And it's a pleasure to be at the UBS Center. Look, Ralph, I started really thinking about economics when, I was in India. And India, in my youth, was still a very poor country. And my father was in the diplomatic service, and we had been in Belgium just before we came back to India. And you could see the contrast, supermarkets full of stuff. In Belgium, nothing really available. Even milk was rationed, bread was rationed. Why are we so poor? So it certainly is a question that stays with you if you are from a poor country. And, in school, a friend said, why don't you try doing econometrics? That sort of will go with your math. And apparently it's a way of predicting how people behave. It's a very loose sense of econometrics. But I thought, well, that might be fun. So I started thinking about doing more economics. But then in India, what you do is, you need a job. We weren't independently wealthy. So I sat for one of the Indian Institute of Technology exams, which is, even then was very competitive. Now it's hyper competitive, but there it was just competitive. And you worked, a couple of years and then gave the exam and hoped and prayed that you got in. And I did get in. And I sort of succumbed to the sunk cost fallacy. If you work so hard,
I see. You need to
and you
do
got
it.
it, and you might as well take it. So I became an engineer, an electrical engineer. But somewhere around third year, when we were doing fields and waves, I said, I don't connect. I just don't see how fields and waves sort of affect real people. We were doing Maxwell's equations and so on. So I wanted out of that. And so from engineering, I did an MBA, which seemed like a halfway house towards economics. And then finally, I did a PhD in economics, actually a PhD in finance. One of my critics in India always said, this guy's a fake economist. He doesn't have a single economics degree. And I said, he's actually right. I don't have a single economics degree. My PhD is from Sloan at MIT in management. But so I entered academia, and I always wanted.
If I could ask you, I mean, that's really interesting. You started off with this experience in your childhood, or maybe when you were younger, seeing Belgium, seeing India, and seeing the differences. So really interested in questions of growth and questions of development, and I know you've also worked on institutions, of course. So this is something that you focused on, and then later on. But how did it happen that you ended up being a finance professor now?
Well, that was the only thing that was open, right? See, I didn't have a degree in economics, so I couldn't apply to economics departments. And I was in a business school where, I did finance courses. I also did some economics courses, but then I could apply to finance programs. And so I applied, and by some stroke of luck, MIT gave me admission and a scholarship, and I went there. And it was, just sitting in class, sitting in the, seeing Peter Diamond teach. And it was a revelation. I mean, I think the biggest revelation was that, at that time he was rumored to be, a guy who would get the Nobel Prize. Eventually he ended up getting it. But he was my first class, and he was making mistakes on the board, teaching his own papers. And then you realize, well, this is a great man, but he's human, which is an important revelation if you have to do any research, because otherwise research seems so, complete and fully formed. You have to realize, these are people who've sort of developed this. It doesn't come sort of a revelation without hard
It looks
work.
great when it's done, but yeah,
exactly. So, after that I went to academia, but it was still, the notion behind doing a PhD was always, I'll go to the World Bank or the IMF where I'll have some impact on development. But as you know, I did a summer at the World Bank, and then I realized, there's a lot of bureaucracy there, and academia socializes you to do the academic thing at the end.
Exactly.
So I ended up in academia, but I always wanted to do some policy. And I realized, sitting outside and writing papers and advising sort of is a little like it washes off. Unless it's really fundamental, nobody's going to really take it up and do something about it. You have to be not even an advisor and actually implementer. But I thought, let me first get to the advice point. So, when I was in my early 40s, I suddenly got a call from Ann Krieger, who I knew, who was at the IMF. We had met at a bunch of conferences, and the IMF was now interested in a finance guy. Because of the Asian financial crisis, they thought they didn't understand finance enough. It was more of it's mostly fiscal, the IMF guy.
That's interesting.
And they had this template which they put on the East Asian economies, which didn't seem right. And so they wanted to understand finance more. And Anne was looking for a finance person, and then she remembered that, I existed. So she called me up and she said, would you like to interview for the job of chief economist? I said, Anne, I don't know any macroeconomics. Instead, that makes two of us. So, she's a trade economist. I'm a finance guy. We do know some macroeconomics. And then I realized macro is just a question of what you think is exogenous. Once you know what is the outside force, everything else falls into place. And people debate till the cows come home about which one is more exogenous than the other. So
That's funny.
that was at least how macro was explained to me by my colleague Tom Heisinger at Chicago. At any rate, I went to the IMF, and it was interesting because I did have to learn the tools of the trade. And, in any such organization, you understand that you come with certain skills. You do want to emphasize those because, but you can't default on the others. I used to spend a lot of time saying I'm not an economist, until my staff said, you're leading
the chief
economics
economist
department in the most prestigious multilateral organization in economics, and you were not allowed to say you're not an economist. So I stopped saying that.
But remind me, so this was pre-global financial crisis,
This was
right?
pre-global financial crisis, and you learn. on the job. You learn your macroeconomics, you learn trade, you learn adding up constraints and so on. One of the big issues then was really, at that point, global imbalances. The US running a huge trade deficit, China on a large part of the other side. And so then the question was, how do we bring it down? But meanwhile, I was also getting very worried about the financial system. And, one of the things during my stay there was I was asked to give a speech at Jackson Hole on Greenspan's tenure. Greenspan had been really very successful and was looked upon with awe. He had seen the productivity boom in the late 90s and had not raised interest rates for fear the economy was overheating, which was the right call at that point. But what happened was there was a financial boom also at the same time. And if you remember the dot-com boom and then dot-com collapse. And so that became part of the Greenspan doctrine, and we can talk about this later, that you can't sort of stop the boom when it happens, but you can pick up the pieces when it crashes. And this sort of, the Greenspan put became a matter of Fed mantra. Don't try and sort of offset the boom because you don't know which one is a real boom and which one isn't. But, use all monetary tools to elevate the economy once it crashes. And so, but this was 2005, and we were asked to give a speech extolling his virtues, and I was very impressed with Greenspan. And I started writing a speech which would say how wonderful things are and so on. And then as I wrote it, I started thinking, well, doesn't seem to be any risk in the system. Where has it gone? It struck me that what we had was a system which was taking massive tail risk. And not, tail risk is rarely priced properly. And the tail risk was coming back to the banking system. And so then the question was, what would happen if those risks materialized? It was essentially the system, a large part of the financial system was writing deep out of the money options. What does that mean? It's a form of insurance. When the bad stuff doesn't happen, you pay me a premium and I make money. But if the bad stuff happens, and that's going to be a very small probability tail risk, then I have to pay you enormous amounts of money. And so the financial system was looking very profitable as it took such bets. Remember, AIG was writing credit default swaps up the wazoo, huge amounts of it. And people were acting as if, once they had that swap, they were perfectly safe because they were protected by AIG, which was a really good name. But essentially, the system was taking more and more risk. A lot of it, calculated to emerge when everything went south.
But it's really, if I recall correctly, that was not what most people were talking about at the time. So you were one of the first to point to these risks also in the financial system, right? So in a way it was, and later, I probably at the time the paper you gave at Jackson Hole wasn't so happily received, but certainly afterwards, people with the benefit of hindsight also saw that there was something really, really important in there. But before we get there, I'm kind of struck. The IMF. The fact that they recruited you. Was pretty wise. That they kind of saw there was some issues in finance, and we need a finance expert.
So it was a combination of the managing director then, Horst Kohler, who felt a certain amount of. He was the German G7 member when the Asian financial crisis happened.
I see.
And he felt the anger of the East Asians when they said, the IMF has come up with all these recommendations which aren't appropriate to us. It's sort of, they're putting the boilerplate recommendations on us. Why is that? And Kohler sort of decided that the IMF had to change and had to figure out what went wrong there.
I see.
And Anne was a very able sort of deputy to him, and to her credit, she gave me full rein, including in this kind of speech, because the other side of the IMF, IMF has two counselors. One is an economic counselor, one is a finance counselor. The finance side was saying how wonderful this is, everything's going well.
So you were even stepping into their territory.
I was stepping into their turf, and I was, in fact, my speech at Jackson Hole was not really, didn't go through the entire IMF screening, otherwise it would have been stopped. Luckily, Anne was there at that meeting, and she said, perfectly the right thing to do. But what was interesting, and we can come to this later, is that there is no sort of reason for people to. Everything I said was in plain sight. I was joining the dots. But at a time like this, from the perspective of the authorities, it could be one of many risks that people keep talking about. And so why give this prominence? It's a possibility. So, the sky could fall on our head. That's also a possibility. Why give this more weight? That's one view. Another view is it's already too late. Things are, already in ferment. And trying to stop this would actually bring the whole, house of cards down. I think there's a mix of both in why the authorities don't act.
I see.
There's always people warning that the sky is going to fall down. Once it does, then they say, "See, I told you so." Well, which sort of risk do you pay attention to? But the other is a very real worry that if you try and stop it with hard measures, you collapse the system. I don't think, if you look in hindsight, 2006, 2007 were the real go-go years when the system really took off. 2005, which is when I gave the speech, was sort of beginning. And it was interesting because the authorities then were asking the private sector, you guys are the smartest guys in the room, why aren't you doing anything about it? And the private sector, this was a conversation at that Jackson Hole meeting, was sort of pushing back at the authorities and saying, "You're the guys who have to stop us."
I see.
That was an interesting conversation. I won't say who participated, but it was an eye-opener for me. At any rate, so that was fun, and it was fun. I learned a huge amount, but then I realized that in multilateral institutions, unless you have a country which is doing a program, and in my time at the fund, all the countries were getting off programs. It was a great time for EMs and DM and developing countries, but then I realized you have to be in the thick of things. You have to be doing stuff if you want to make any policy change. And so, soon after, I was asked to head a commission to look at India's financial sector reforms. I did that, started chatting with the Prime Minister, Dr. Manmohan Singh, who's an economist, and eventually called me back to India to be chief economic advisor.
But you went back to Booth for
I went back to Booth. I went back to academia for a few years, did this commission, and then they called me back to be the chief economic advisor, and then appointed me governor. It was an interesting time again, because at that time we were undergoing the taper tantrum. If you recall, Chairman Bernanke had talked about the end of quantitative easing, and that sort of set off markets. They went crazy. India was termed one of the fragile five. The exchange rate fell 20%, and when those things happen, you're in real sort of crisis mode. how do you stabilize the exchange rate? How do you do anything to bring the economy back?
So you had to step in right away. So when you started your term, was already India was in the middle of it. You had to act.
It was very
That's
volatile.
interesting.
And I was important. I said, look, and there were concerns about the government, corruption scandals, etc. The opposition wasn't letting the government function. So I said, look, the way to convince markets that India is good for it is to offer a program of reform. And we should do it right off the bat. But since the government is paralyzed, it's not going to go through parliament, etc. What's a program that the Reserve Bank can offer? And so we, in the days before I took office, I put down, 10 big things that we could do, including moving to an inflation targeting framework. My Latin American friends had said, the way to stabilize a currency, don't talk about it. Talk about inflation. And once you convince the markets that you're good for on the inflation side, confidence will come back. I mean, Augustine Carstens, Arminio Fraga, they were good friends. They are good friends, and they gave me this advice.
So you had a bit of a support network.
It was just the right thing to do. So we didn't talk about the exchange rate. We talked about inflation. And so we talked about putting up a committee to look at inflation targeting. We talked about liberalizing bank licensing, bank branching, a whole bunch of new schemes to expand credit. Basically set forward a reform agenda, which I announced on my first day, and a scheme which was a little risky, but a scheme to bring back money into India using non-resident deposits, but with a sort of floor on the currency that we offered as a support to banks bringing in money, and we raised 30 billion.
No, so it was some scheme that gave incentives to repatriate money to India?
So I thought it was very important to send a signal that we could raise the money if we wanted to.
I see.
And India wasn't getting swaps from the Fed. So how do we convince? We have non-resident Indians who deposit money. And so we told them, you deposit money, here's a good interest rate, a dollar interest rate, plus we give you a floor at which you can get out on the rupee-dollar exchange rate. So that was a kind of guarantee.
I see.
And I agonized over that because I said, look, this is a scheme that the bankers would love because they can make money on this, but is it a scheme that is useful for the country? And I finally convinced myself that if enough money comes in, essentially the rupee would appreciate enough that this floor would never be hit. And so it was one of those, as the central bank, you're the only one who can make this kind of bet, because you're betting on the quantities being enough that the floor is never tested.
But so one thing I would be really interested in, if you're the chief economist of the IMF, in a way, I mean, yes, you're not an academic anymore, you're part of a policy institution and you have to lead a team and you have to interact with policymakers, but you're still the expert. I mean, you're maybe the chief expert, but then you move to being a governor of a central bank. It's a very different kind of job profile, right? Now you're at the helm of this institution. How was that for you, moving into that?
I think the IMF was excellent preparation. Because now you know exactly what that job entails. But it's important to be expert at something, either in terms of your experience, so you've been a central banker for 25 years, or in terms of your knowledge. I had worked in academia on some of these issues, not so much monetary policy, but credit and liquidity risks and so on. So I could talk the language that I needed to talk. But importantly, I brought something to the table. And then I could, my colleagues at the central bank, I could tell them, here's what I bring. I want to know what your experience tells you. And we always had a dialogue on any policy issue, informed by the experience and by my sort of academic training. My training caused me to question received wisdom. Their experience told them why the received wisdom was right or wrong. And we never did anything that they were firmly against. But that was sensible. You have to know when to listen. But you also have to push, otherwise you don't get reforms done. So that list that we prepared on the first day, we achieved every single one of those, including a glide path. We had inflation at around 10 double digits. We brought it down to the center of the proposed inflation targeting regime.
But if I recall correctly, it also wasn't all 100% popular, right? I was when I was looking yesterday, preparing a little bit for our conversation today, I came across this anecdote you had with a Chicago cab driver complaining about Indian monetary policy, and actually reminded me that I must have been in a cab with a similar, with maybe even the same cab driver in Chicago. I remember one time someone picking me up from the airport was an Indian cab driver, and he so normally I get along very well with people, but he ended up not liking me at the end of the trip. The first point of contention was that I was German, and he had some theory about the German automotive industry doing something unfair to the Indian automotive industry. And then the second thing he found out is that my wife is Pakistani. He didn't like that very much. And then the third thing he found out is that I was working at Chicago booth and that you were also there. And then he started talking about Indian central banking. So was that a...
Two strikes and you're right.
Exactly.
No, the people loved the outcome, which is India's had low inflation.
That's a big achievement.
Last time we hit double digits was at the beginning of my term. And it's been, I think they've had to write a letter maybe twice or once, and inflation is now 2%. So through the pandemic, inflation was contained. I think that's an achievement. Obviously, it's not, it's a sequence of central bank governors who did the right thing, but it was important that the framework change from, we do whatever we feel, to here's what we're trying to do, which is the discipline that an inflation targeting regime brings. I think there was a separate issue with the BJP, the ruling party, which was because I was a holdover from the Congress regime, I was always viewed with suspicion.
Oh, I see.
And so there were a couple of politicians from the BJP who were unleashed to criticize, much as you see, Chair Powell being criticized by. It was for no purpose, because I raised interest rates during the Congress regime, the ones who appointed me, and I only cut interest rates during the BJP regime because we had brought down inflation to the point we could. But it was a political issue. It wasn't economic. But there were other issues we had to deal with. Cleaning up the banks. The banks were full of bad loans. Again, accumulated post-global financial crisis, but they were evergreening them. So you had to start getting the process of recognizing them, but they didn't have enough tools to clean up once they recognized. So you had to give them more powers. We were trying to do it through the regulatory route, give them more powers. But eventually we got a bankruptcy code after my term ended, and that helped the cleanup. But we first had to force recognition. So bad loans went up hugely. And again, some people started saying, oh, you created the bad loans. We forced the recognition of bad loans because that was a prelude to the cleanup. But there were lots of other, I was like a kid in a candy shop. There's so many things you can do. And now, unlike when you're an advisor, you actually can move the needle at the end of the day. You feel on some days you did something useful. So UPI, this system of making transfers bank to bank, that was started in my time. Last I checked, there's some 18 billion transactions. Wow. This is all very 15 billion a month. Sorry, this is stuff where you. I mean, I go back to India now. I see, branches of banks that be licensed, and people were really scared of licensing banks. Oh, don't we have enough competition already? Oh, these guys would get into trouble. And you weren't allowing that kind of expansion, which I think was very important. So it was fun, but then I think these kinds of my term got to the end, and then my wife said, "What are you hanging on for?" I said, "I want to clean up the banks." But then there was something else coming down the line, which was the demonetization. What the political establishment wanted to do, the then administration, is demonetize notes because they thought that they would capture a lot of black money. And my advice was don't, because people will find ways around it. You need a totally non-corrupt system to demonetize and hope that all the black money doesn't come back in one guise or the other. And that's actually what turned out. All the money came back. But bottom line was I was against it. And I think at the end of my term, we parted company with the government, and it was probably the right decision for both of us. They wanted somebody they could rely on. I was probably going to do demonetization with a lot of concern. And so we parted, and I went back to academia and have then been trying to write papers.
But maybe before we start talking about the current situation, maybe one last reflection about academia versus policy. What in your experience were the main differences between the? I mean, you've worked at the highest levels now in both academia and policy. How would you compare the two?
They're obviously very different. When you're working in policy, if you're in the right place at the right time, you can have an enormous amount of influence. You can do things that actually change people's lives, and you can feel good about it. Academia, it's more you're trying to write for the people who might have the possibility of changing. But if you can reach the right person with your advice, then academia also has impact. So I have never felt in seminars after returning from policy sort of positions, some of my colleagues used to say, well, we feel we're talking about counting angels on the head of a pin. That's what academia looks like. I haven't felt that. I sort of think there's a role for academia trying to do things rigorously and showing things. But somebody has to take that up and do it. And there aren't that many academic papers which have such a clear policy implication that they can be taken up and done by somebody else. I had the luxury of, running a committee which proposed a bunch of things and then being able to carry it out as governor. But it was important for me to understand what those things were and to push it forward. I think it's useful to have informed policymakers, but that translation is where a lot of things get lost, from where the idea emerges and the person who can carry it out.
But my impression was always that, at least in macro finance, central banking circles, IMF, and so on, probably the link between academia and policymaking is quite close. I remember being at an event at the BIS where one of their senior staff was giving I thought, quite complicated lecture on some monetary policy issue. I was sure central bank governors wouldn't follow, from my experience at the WTO with policymakers, and they all followed. So it seemed like the level of the discussion was quite high.
It's closer. The link is closer when you're doing fairly applied monetary policy. You're running regressions, then you're telling sort of central bankers about what's going on the macro side. The link gets more tenuous as you're talking about microeconomic reforms,
Right?
Where you're saying do thus and such. offer credits to this entity or do that. And there, you need to convince a policymaker to carry it out. It's not so obvious. And that's where, the gap comes. Let me give an example. We have these priority sector norms for Indian banks. X% of their portfolio has to be lent to the priority sector, which means small and medium enterprises, farmers, et cetera, et cetera. Now, some banks are better at it than other banks. This is a clear case where a cap and trade system would work well. Some banks can overperform and sell their credits to other banks. But how do you convince a central banker who's dealing with monetary policy that this is really very important?
Right.
So, fortunately, we had the idea in the committee, and I became governor. So we implemented it, and now it's running well. It's actually caught on, and it works.
That's fascinating. It's of course also a great opportunity if you can do both. But maybe we can switch a little bit and talk also about the current situation, trade tensions, but also what some of your concerns are surrounding these trade tensions, and particularly perhaps also the state of the financial system. I mean, one thing, maybe just an opening question I can ask you. One thing I'm always perplexed by is by how well stock markets are doing these days, given that we have pretty unconventional policy mix. We have, of course, the trade policy, where you might argue that perhaps for the United States not that important, is perhaps a bigger problem for the rest of the world than the United States. But you also have a tax on central bank independence. You have arguably also pressure on the whole institutional setup of the U.S. economic governance. So I'd just be curious about your take on what's going on and what might be next.
So I think there are a bunch of factors that are playing out right now, right? So let's look at stuff that might be pushing up growth and expectations. One, of course, is the AI boom and the tremendous investment that's going in. Whether this boom sort of materializes, people say, it's obvious that AI will be a big factor in the coming years. But, with any such big factor, the question is, what is the timeliness of the returns that come? Is it now or way down the line? And that, I think, nobody really knows, because it also depends on the speed of implementation of AI in companies. And companies are always much slower than the guys who produce the AI. So that's one issue. I think the second issue is who makes money? Is it the guys making the investment who make the money, or the guys who are running the applications who make the money, or somebody else who comes in and disrupts everything in the process? So one is when. The second is who makes money. And then there's a third issue, which is the extent to which the political economy doesn't sort of intervene in all this. I mean, one example, you're already seeing a big concern in the United States, Georgia, for example, about who pays for the electricity. These data centers are going to be huge sort of consumers of power. And right now, you're using sort of old practices of burden sharing. But why does a consumer in Georgia care about the fact that you're providing sort of data centers to the rest of the US and to the rest of the world? Who's paying for this? It shouldn't be the Georgian consumer. So lots of issues to come up, including, the projections for the additional power that's needed are huge. Where is that going to come from? The speed of licensing of all that, And of course, there's a possibility that you end up with AI which doesn't require so much power. Power stations take a long time to build. Have you got stranded power, then this is all complicated, right? So, but right now, the euphoria, which is always the first, is lifting a lot of ships, primarily the superscalers, but also others who might be connected. So that's one. And that's adding seriously to growth if you look at the size of the investment that's taking place. In Europe, I think the defense spending is having a similar effect in anticipation of massive investments and therefore spillovers, including the fact that Germany has let go of a debt brake. And that is going to add to spending in the years to come. And you see, European growth prospects improving even in the last couple of quarters. So that's, I think, a second. A third is, of course, we still have enormous fiscal support in the U.S. 6.5% of GDP as a deficit in good times. It seems, there's no tomorrow in fiscal thinking. So that's also been hugely supportive. And my guess is these additional, EU measures, for example, for defense support and so on, are also going to do something similar in Europe. And of course, Asia is being dragged along on some of this, but it's going to have its own sort of push towards more defense spending. That's the upside. And I think some of that is buoying markets. The reality is the U.S. consumer at the upper end is still spending hugely, partly lifted by wealth effects. At the lower end, they're facing more difficulties. But this is, a rising tide. There was so much fear for the last couple of years that the Fed interest rates increases, which were sharp, would slow down the economy. They happened.
And it didn't, yeah.
And that's the other part of the story which I worry about. Why is it that these sharp interest rate increases haven't slowed anything down? And one you could argue is it's the enormous fiscal support given during the pandemic, fact that many firms sort of essentially refinanced themselves, and so they were much more sort of immune to sharp rises in interest rates. And by the time you think they might have started having financial difficulties, the Fed started cutting rates. So they were okay. That's one argument. But the other argument I think that's important to consider is that there's been an enormous amount of liquidity infused in the system through all the quantitative easing that different central banks have done, as well as the implicit put that many of them have offered. If things go sour, we'll come in.
The Greenspan
The
one you
Greenspan
mentioned before.
So we're coming back to that,
exactly.
that statement I made earlier. And if you put these two things together, then you start saying, well, maybe this explains why when the Fed raises interest rates in an unprecedented and fast way, the system doesn't back up. What they call financial conditions don't really turn adverse seriously because there's so much liquidity in the system. It's being buoyed by that. And now, liquidity is one of those terms which sort of represents everything. And I know it's fast and loose, but it's a way of saying that when people don't fear a backing up of the system, they're willing to take bigger bets. When they're willing to take bigger bets, then everybody feels comfortable because you don't see any end to this.
There's a bit of a moral hazard issue then also.
It is huge moral hazard. And that's my worry, that what was the downside risk we didn't talk about? It's the huge fiscal fiscal pressures that will start coming as real interest rates stay with all this investment and all that, as real interest rates stay relatively high, the magic R star that central bankers talk about, as that stays higher than the pre-pandemic, and with debt to GDP in many advanced economies hovering around 100% of GDP, in some, of course, higher, in some, like Germany, lower. But with debt to GDP around 100%, 1 or 2 percentage points increases in real rates means a huge additional burden. But that's not the worry that I have most, which my greater worry is, what if there's another financial crisis and you have to bail out the system? Well, what's the difficulty that EMs and developing countries face in bailing out a system? It's that government doesn't have fiscal space. So the central bank is not that credible when it comes in and says, we're going to bail out this and bail out that, because there's no fiscal backing to the central bank, or there's no direct treasury support of the banks that are going bust. And so the crisis becomes really severe. Developed countries, how much sort of support can they give now when their debt to GDP is 100% and climbing? We're talking about financial crisis, 10%, 15% of GDP.
But if I hear you correctly, so yeah, you're seeing the risk more broadly, not just in the United States. Did I hear?
Yeah, I'm talking more broadly, though. I think because of the US's financial system, it takes more advantage of any potential support than say Europe. For example, speculative finance, I think, is far more advanced in the US.
Like cryptocurrencies and things
Crypto,
like that.
but more the bond basis trade, which is a way for investment bank for insurance companies and pension funds to get a little boost on their investments by investing in corporates and getting a little additional spread rather than investing in treasuries, but then effectively hedging it. But that hedge is provided by hedge funds. And anytime there's disruption in financial markets, that whole sort of set of transactions starts exploding. Just like LDI happened in the UK. I think the Anglo-American economies are much more exposed to this kind of speculative finance, and therefore have a greater risk. Of course, when they go down, European banks are also drawn in because they play a big part in the US, and so they're not immune.
But then, if your diagnosis is right, and it certainly seems plausible to me, you would expect that, or you would hope that the U.S. Fed or other central banks are doing something now to lean against it to some extent. And I don't know, my reading of the current situation is that if anything, we're going to get the opposite. No, we're going to get looser monetary policy. We're going to get more financial deregulation. I don't see anyone trying to slow things down or rein things in. Is that also your perspective?
It is, which is why I wrote an op-ed in the FT sometime back, basically saying, look, it is true that there's no clear and present danger right now. It's not obvious where things will collapse. But this is really the time when you should be very careful, because of the exuberance in financial markets. You haven't slowed that down. And now you're cutting rates into this exuberance.
Exactly.
So you have to be really careful you don't set off a process of risk-taking. I mean, so where could this come from? We talked about AI. AI investment so far has been done by the superscalers using their internal funds, for the most part. Not all, but for the most part. Now, the size of the investment that they need to make is exceeding their own internal funding capacity. So they're sort of outsourcing that investment. And clearly now it's being supported by credit. Credit and asset high asset prices. That's a very dangerous combination because one relies on the other. And we're sort of moving into that. And my worry is if you cut interest rates seriously into that process, you fuel the credit process. Now, I'm not saying that, monetary policy should be on hold. I'm saying it should be very careful now about doing too much. Do a little bit,
I see.
but what is sometimes called an insurance cut, in order to make sure that the labor markets sort of stabilize, may actually give incentives to the financial markets to take off once again. So I would say you need to put in the financial markets and their exuberance as a third factor, in addition to labor markets and inflation. And just looking at the two and saying that's all. And you will never hear central bankers talking about more than the two, because they're sort of almost programmed to say, oh, the financial markets, we can't do anything about. I think that's a mistake. And it's a mistake I've been talking about for 20 years now, that you need to worry about that. And yeah, it may make your monetary policy more messy. But if you don't, you get the crisis. And I'm saying the last two crises, the global financial crisis and the pandemic, you could afford. Now it's becoming less affordable because of your debt to GDP ratios.
But it's really interesting if we come back to your biography from the beginning, how you had this Jackson Hole speech and made this point, and in a way, variants of this point, or versions of this point have been, it seems like at least, have been accompanying you now over your career, and even what we're talking about now, to some extent, is related to what you already pointed out back then. So it's
well, yeah. So my greatest fear as an academic is writing the same paper 30 times, right? But at the same time, the real impact you can have as an academic is making the same point in different ways, so that it gets through. And another way of making the point I've been making, just wrote a recent paper on it, is when the authorities intervene, they make the price of illiquidity too low. And the private sector, when it sees that price of illiquidity as too low, takes full advantage of it, right? So one way to see this is if you look at the Fed and its balance sheet, think of the Fed's balance sheet as it expands it, as it's creating bank reserves. And bank reserves are the most liquid asset in the planet. So when the Fed expands its balance sheet, it's increasing liquidity in the system. So you would think the Fed would expand it, create a little bit of liquidity, and that's enough. And when the need for that goes away, it can shrink it. Turns out the Fed's balance sheet was about $80 billion before the global financial crisis. It expanded it through a set of what it calls quantitative easing. In 2019, it was 1.4 trillion in reserves. Balance sheet was bigger, reserves were 1.4 trillion. The system backed up in 2019 when the reserves were 1.4 trillion. So the Fed expanded again. Through pandemic, etc. Cut a long story short, reserves are now 3 trillion. The Fed has stopped shrinking its balance sheet at 3 trillion in reserves. 80 billion 20 years ago, 3 trillion now, about 35 times what it was then. The economy is not 35 times bigger. But the system has gotten to use this wall, which means the Fed shrinks even a little, the system starts backing up and the Fed says, okay, uncle, this is where I am. So the system is more and more dependent on the Fed to provide liquidity, which means that liquidity is being taken full advantage of, and is probably hugely underpriced. Why is that important? It means that we take this goes back to the Austrian school of economists, what they call malinvestment. We take longer and longer duration projects because we don't worry about the fact that, maybe people want their money in between. Maybe there's fear, there's this thing, illiquidity. So the good thing is we can take all these long-term projects. The bad thing is we're not prepared for when the market sort of turns and says, and the only people who can come in are the authorities at that point. And what I'm saying is, so far the authorities have been able to come in. But it's getting harder and harder because this capacity to intervene is getting harder because of the fiscal constraints of having intervened in the past and spending all that money. And so as a society, we need to see this as a potential problem that maybe we should price liquidity a little better. And that means reining in the central banks, getting in. It's a process. It won't happen overnight, but we need to first understand it's a problem.
No, it's very, very interesting, and it's. I think it's also amazing that you see this red line in a way through your biography. We're almost out of time, but I would like to ask you one last big picture question. Stepping away from the current situation in financial markets, perhaps, and if you look at the global financial architecture, but also the multilateral architecture, let's say more broadly, if you think about the IMF, the World Bank, the WTO, and so on. In the past, you did have a system that was very much dominated formally and informally by the United States. My impression is that we're moving towards a world that is much more multipolar, with players like India, with players like China, but also Indonesia, also Brazil, also South Africa, taking a more important role. And at least my observation now, when we also look at the trade tensions, is that this is exactly what's kind of unfolding, because you see the real opposition now to the tariffs came from China, came from Brazil, came from India. So there's a bunch of countries who don't seem to want to put up anymore with this system that we used to have. So just given your experience both in a high-level policy position in India, but also, of course, your experience in the United States, just in closing, I just wanted to ask you what your sense is of more broadly what we are moving towards in terms of international governance.
I think, you having spent some time at the WTO know this better than I do, but we have not fully addressed the political economy of trade within country, right? I mean, the arguments about trade are always, look, it's beneficial for the country, and there'll be losers, there'll be winners, and we find a way to compensate the losers. And we never do that. Now, I think this played out in many emerging markets in the 80s and the 90s, that they opened up. There was, some gainers, some winners, some losers. But democracy was rarely strong enough for the losers to stand up and say, we're losing out. And so, overall, the country was lifted, and eventually the gains flowed to the losers, and everybody was a little happier. But, there was a process, there's a period of stress. And I remember one of my colleagues at the IMF, who had joined recently when I was the chief economist, couldn't get a job anywhere else. This was the early 2000s, because she had a paper showing how, certain districts in India were hurt by free trade.
Oh, Petya Topalova.
Petya Topalova, and fantastic sort of economist, but she ended up at the IMF, which is a good place. But I think she would have loved to be in a top economics department, because there wasn't the receptivity to the downsides of trade. Now, a few years later, when this was done in the context of not the same thing, but something similar, the costs of trade in the context of China causing the US to lose jobs, it made a big splash, and then people started revising their views.
Exactly.
But I don't think I think the developed countries, there's more democratic pushback on trade, the rise of people like Trump, but also the Democratic Party turning against trade in the US. So unless we address that issue of the people who don't gain from trade, it's very hard within country to, especially when it's democratic and when all these questions have been raised about trade, to get it to be a full participant once again. And so, countries have succeeded. The Scandinavian countries have always been very good at dealing with job losses from trade, allowing for mobility of workers and so on. We need to understand how that's done and do more of that. And this is going to be an issue in emerging markets. Why am I saying this? I'm saying that the overall consensus for trade, lifting all boats, plays out well in the long run, but there are medium run issues you got to deal with. And I think even the emerging markets are now seeing some of the consequences, and there are pressures. There were always pressures within them to not open up, and then they opened up, did well. Now, given that trade is again becoming an issue, there will be pressures to close down. So I do think many of them are convinced trade is good and will find ways to do these kinds of partnerships. So yes, we will see regional sort of structures, maybe even something like that. The former TPP could become a global structure, but they're all partial, as you well understand. But more important, I think, is what the system lacks is an authority. You're not going to give the bureaucrats the authority to slap somebody who gets out of line. It used to be something done by the US, both carrots and sticks. Sometimes it used to take the hit, sometimes it used to offer the carrot. I think without a hegemon, these systems may find that they're more reliant on rules being well done and less. It does raise the question: do the rules become too onerous at some point? And how does the renegotiation of the rules take place? A little bit of flexibility in these structures is useful, but that requires some of the players to step up and say, okay, in this kind of environment, I'll take the hit just to keep things going. And that, to my mind, is what we have to see play out, whether this system works reasonably well. Ideally, what would happen is the US sees some of the costs now. Maybe with 15% tariffs, you don't see the costs too much. But you see that this becomes a system which is full of rent seeking. That was the Indian experience. Everybody in Washington lobbying for their particular product being excluded. And at some point, somebody says, this is a den of corruption. Let's get rid of this and go back to where we were. Hopefully, some of that happens. But I think for anything to change, we also need to have a good system of protecting those who lose out. And that we need to work much harder on, because that's something that's broken.
Well, thank you very much, Raghu. Actually reminds me the discussion about winners and losers within countries and also increasing inequality reminds me of a seminar comment you made at Chicago booth once, somehow stuck with me, where someone was also talking about increases in within country inequality, which is of course important. But then I remember you pointing out that between country inequality has been falling dramatically, and of course trade also playing a very important role in that, literally lifting hundreds of millions out of poverty, which of course doesn't address the political economy consideration that you raise, but is also I think very important. I think we're out of time, Raghu. So thank you very much for sharing all this with us. I thought it was very interesting to hear both a little bit about your biography as well as your take on current issues. So thank you very much for coming.
Well, thanks for listening. Thanks, Ralph.